Tesla's Q3 earnings report is just days away, and it could be the most pivotal moment for the company this year. Investors, brace yourselves. This report could either send Tesla's stock soaring to new heights or crashing down. Wall Street's expectations are mixed, but one thing is clear. This isn't a report you can afford to ignore. Are you prepared for the make or break moment that could define Tesla's future? Stay tuned because what I'm about to reveal might completely change how you see Tesla stock. Let's dive into what the market is currently expecting. Analysts have set the bar with the Zacks consensus estimate predicting Tesla's Q3 earnings at 58 cents per share and revenue around $25.6 million. These numbers show a slight revision upward, but the overall sentiment remains cautious, as projections still indicate a 12.12% drop in earnings per share compared to last year. What's more, even though revenue is expected to increase by 9.5%, the focus is on how Tesla's shrinking margins might impact the final figures. Investors are bracing for potential volatility given Tesla's history of missing EPS targets. Will this quarter be any different, or are we in for another surprise? Let's keep digging. Now, let's take a closer look at Tesla's performance history because it's crucial in understanding the stakes for this Q3 report. In the last 4 quarters, Tesla has consistently missed its earnings per share, EPS estimates, delivering an average negative earnings surprise of 8%. That means, despite the hype and the ambitious targets Tesla often sets, it struggled to meet the profitability expectations set by analysts. But why does this matter so much right now? Simple. Tesla's stock is known for its volatility, and each earnings miss has historically led to significant price swings, sometimes as much as 10 to 12% within a week of the report. Investors and traders are well aware of this pattern, making this Q3 report a critical moment. A miss could not only trigger a sell-off, but could also shake confidence in Tesla's long-term growth trajectory, especially as the company battles shrinking margins and increased competition. However, it's not just about meeting the EPS figure. It's also about the narrative Tesla can craft around its performance. Even if they miss, strong guidance and future prospects have in the past mitigated immediate sell-offs and even set up the stock for rebounds. So the question is, can Tesla turn the tide this quarter, or are we in for another setback that sends the stock reeling? Let's move on and examine what's driving these expectations. Let's talk numbers, specifically Tesla's production and delivery figures for Q3, which are central to understanding the company's current state. Tesla reported the production of 469,796 vehicles this quarter, with deliveries totaling 462,890 units. This might sound impressive at first glance, but when you compare it to the Zacks consensus estimate of 471,599 deliveries, it's clear they came up short. Even so, this delivery figure represents a 4.3% increase from the previous quarter and marks the first year-over-year growth Tesla has seen in 2024. Now, why does this matter for investors? Because these delivery numbers are more than just statistics. They're a key indicator of demand and operational efficiency. While Tesla's year-over-year growth is a positive signal, missing analyst estimates is still a concern. It's a reminder that Tesla's ability to match production with demand is under pressure, especially as it navigates challenges like intensified competition in the EV space and price cuts that are designed to boost sales but can also erode margins. The real question is, will the market see this delivery increase as a sign of resilience, or will the miss overshadow it, leaving investors to fear that Tesla's growth momentum is slowing? The delivery figures set the stage for what's next in the earnings call, where Tesla will need to explain how it plans to bridge these gaps and sustain growth in the face of rising competition and economic challenges. Now let's focus on Tesla's strategy of price cuts and incentives, an approach that's both boosted sales and raised eyebrows. Tesla implemented aggressive price reductions across its Model 3 and Model I lines this quarter, aiming to stimulate demand and fend off increasing competition from other EV makers, particularly in the Asian markets. These tactics have indeed resulted in a modest bump in sales figures, as we saw with a 4.3% quarter-over-quarter delivery growth. But these gains come at a cost. Tesla's automotive gross margin is projected to drop to 18.3%, down from 18.7% in the same quarter last year. Why is this a concern? Well, margins are a critical part of Tesla's financial health. Investors and analysts alike scrutinize these figures because they reveal whether the company can maintain profitability while scaling production. The dilemma Tesla faces is whether it can keep cutting prices to drive volume without severely impacting its profitability. In essence, they are trading short-term gains in delivery numbers for long-term profitability, and that's a tightrope that's hard to balance. The upcoming Q3 earnings call will likely provide insight into whether Tesla can sustain these tactics or if it's feeling the pinch of thinner margins. The market is waiting to see if these strategies will pay off or if they signal deeper challenges that could pressure the stock further. So, will Tesla's gambit work, or are they sacrificing too much for market share? The answer to this question could determine where Tesla's stock heads next. Tesla's automotive segment may be under pressure, but there's another part of its business that's showing impressive growth: its energy generation and storage division. This quarter, Tesla's energy segment is estimated to generate around $2.16 billion in revenue, a 39% increase year over year. Products like the Megapack and Powerwall are driving this growth, and they're not just adding revenue, they're also boosting profits. The gross profit from this segment is projected to rise over 45%, demonstrating that Tesla's strategic diversification beyond vehicles is gaining momentum. Why does this matter for Tesla's Q3 report? Because the energy segment offers a glimpse into Tesla's future revenue streams. As the automotive margins tighten, this division could become a critical factor in stabilizing Tesla's overall financial performance. Investors are paying close attention to how Tesla manages to expand this part of its business, as it has the potential to offer higher margins and less exposure to the competitive price wars seen in the EV market. However, while these numbers are promising, the energy business still only accounts for a fraction of Tesla's total revenue. The challenge will be scaling it further and faster. If Tesla can demonstrate its ability to expand this segment at a high growth rate, it could reshape investor perception and provide a solid counterbalance to the shrinking margins in its automotive sector. Will this be enough to offset concerns, or is Tesla still too reliant on its vehicle sales for stability? The answer might hold the key to the company's next phase of growth. Tesla isn't just about electric vehicles and energy products. It's a technology powerhouse with an innovation pipeline that keeps investors on their toes. Two of the most talked about advancements this quarter are Tesla's humanoid robot project, Optimus, and the latest iteration of its full self-driving, FSD, beta software version 12.5. These projects highlight Tesla's broader ambitions beyond automotive manufacturing, tapping into artificial intelligence and robotics. The rollout of FSD Beta v12.5 is particularly significant. Elon Musk has positioned it as a breakthrough in autonomous driving, a technology that could revolutionize not just transportation, but Tesla's business model. The potential to generate subscription revenue and expand Tesla's brand as a leader in AI-driven technology could dramatically reshape the company's valuation. However, regulatory hurdles and technical challenges remain, and any delays or issues could undermine these gains. Meanwhile, the Optimus robot project has the potential to create entirely new revenue streams. While it may seem like a futuristic concept, Tesla's demonstrated progress, like autonomous navigation and object manipulation, suggests that this technology isn't as far off as some skeptics might think. If Tesla can continue to show meaningful advancements, it could drive investor enthusiasm and bolster Tesla's image as a tech innovator rather than just a car manufacturer. So while the Q3 earnings will focus on financials, the real narrative Tesla might push could be about its tech evolution. The question is, will these developments be enough to excite investors and distract from the pressure on margins, or are these projects still too far from commercialization to make a tangible impact now? How Tesla frames its progress during the earnings call could sway the stock significantly. Tesla's technological strides are impressive, but they come at a time of internal changes that could have significant implications for the company's operations and strategy. Recently, 4 of Elon Musk's direct reports, key executives who have been instrumental in Tesla's success, announced their departures. Some of these individuals had been with Tesla for nearly a decade, raising questions about the stability and direction of the leadership team. Why is this a concern for investors? Because Tesla's ambitious projects, from scaling EV production to launching robotaxis and advancing AI technologies, require a cohesive and visionary leadership team. The timing of these departures, especially as Tesla is pushing to expand its presence in autonomous driving and robotics, could signal potential disruptions. The market is watching closely to see if these leadership changes impact Tesla's ability to execute its plans effectively. Moreover, with Musk juggling multiple ventures including SpaceX, Neuralink, and X, formerly Twitter, there are growing concerns about whether Tesla's CEO is spread too thin. Investors will be listening closely during a Q3 earnings call for any signs of reassurance or restructuring that could stabilize the leadership situation and ensure that Tesla stays on track. The critical question is, can Tesla maintain its innovative edge and operational efficiency amid these changes, or will the departures create gaps that affect its strategic direction? The way Tesla addresses these concerns will likely play a significant role in shaping market sentiment moving forward. Beyond Tesla's internal dynamics, several external factors are also shaping the company's outlook as we approach the Q3 earnings report. One of the biggest influences is the intensifying competition in the global EV market, particularly from Chinese automakers like BYD and NIO, who are rapidly expanding their reach and undercutting Tesla on price. Tesla's ability to defend its market share, especially in key regions like China and Europe, will be a critical point of focus for investors. Any signs of declining market share could further pressure Tesla's stock. Additionally, the broader economic environment is playing a significant role. High interest rates have made auto loans more expensive, which in turn impacts Tesla's sales, especially in the United States, where consumer spending has shown signs of softening. While the Federal Reserve has hinted at possible rate cuts, any delays could keep these headwinds in place, challenging Tesla's short-term sales targets and margins. Another crucial factor is regulatory risk, particularly as Tesla expands its full self-driving FSD technology to new markets like Europe and China. Regulatory approval remains a significant hurdle, and any setbacks could delay Tesla's plans and the associated revenue streams. Furthermore, Tesla's robotaxi project has raised eyebrows among analysts, as its success is contingent not just on technological advancements, but also on overcoming stringent regulatory requirements. The interplay of these external factors, rising competition, economic pressures, and regulatory challenges adds layers of complexity to Tesla's outlook. The Q3 report will likely address how the company plans to navigate these headwinds and leverage its strengths. The big question is, can Tesla's leadership demonstrate a clear strategy to mitigate these risks, or will these challenges overshadow the positive developments and drag the stock down further? As we approach Tesla's Q3 earnings release, the stakes couldn't be higher. The company finds itself at a crossroads where its performance report and subsequent guidance could either reignite investor confidence or lead to a significant downturn in its stock price. Tesla has shown resilience in the past, but the question remains, can they pull off a surprise that will boost the stock, or are we headed for another disappointment? If Tesla manages to exceed expectations in key areas like demonstrating solid growth in its energy segment or providing encouraging updates on new vehicle models and the rollout of autonomous technologies, investors might overlook the pressure on automotive margins and see the bigger picture. Furthermore, clear guidance on the expansion of the robotaxi program or progress with regulatory approvals for full self-driving (FSD) could shift the focus back to Tesla's long-term potential, driving excitement, and a stock rally. On the other hand, if Tesla's earnings fall short of the already modest expectations, and if the company fails to provide a compelling vision for its future, we could see a significant sell-off. Investors are likely to react strongly to any signs that Tesla is struggling to maintain its growth trajectory, particularly with competition and economic challenges mounting. Ultimately, this earnings report isn't just about Tesla's Q3 numbers. It's about the company's ability to navigate the increasingly complex landscape it operates in. Whether it's through innovative technologies, expanding market presence, or adapting to economic shifts, Tesla needs to prove that it remains a leader in the EV and tech space. Otherwise, the stock might continue its volatile path, testing the patience of even its most loyal investors. So, will Tesla rise to the challenge or stumble under pressure? Stay tuned, because this report could be a defining moment for Tesla's future. And as always, remember to subscribe for updates on Tesla's journey. This analysis is not financial advice. Always do your own research before making investment decisions.